Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Tuesday, April 30th, and joining me as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, hopping right into it. It's a busy week. We're recording this on Tuesday. Tomorrow, we're going to learn a lot. There are a number of economic data points that are going to be released this week, but none of them would be more relevant than A, the Federal Reserve's decision on the borrowing rate, and then what Jerome Powell, chairman of the Federal Reserve, has to say about it. What are you expecting?
Yeah, well, look, the economic data that's coming in right now is, again, showing the strong first quarter that we got, in terms of the economy. The economy really, really strengthened in the first quarter of this year. And early indicators for inflation, other indicators for inflation in the first quarter show inflation basically stalled and may even have, slightly reaccelerated. This morning, we got the employment cost index, which basically measures labor costs. And that came in above expectation at 1.2% quarter over quarter compared to 0.9% forecasted by, the survey of Wall Street Journal and Dow Jones survey of economists. And so, you're seeing the strong increase in labor costs. That's, of course, going to weigh on the Fed decision, on the mind of the FOMC. Of course, the market expects no changes to the federal funds rate. But ultimately, look, looser financial conditions at the start of this year are usually accompanied by a higher output gap and higher inflation. And that's been the story, right? So, financial condition loosened substantially after the December, the Fed chair came out in December, talking about potential rate cuts this year. The market ran with this. At some point, we were pricing in, the market was pricing in roughly 6 to 7 rate cuts. Now we're down to, the first rate market pricing suggests maybe the first rate cut in November of this year. But ultimately, the market still expects about 2 rate cuts in 2024. So I don't know. I don't know. The economic data coming in right now is basically showing the Fed will likely sit back, will not do anything. But the pressure is up, not down. I'm optimistic that inflation will continue to cool. I don't think that consumers, when you look at the personal consumption expenditures data that came out last week, you see basically income growth slowing. You see consumer spending continuing to increase despite the slowdown in income growth, meaning basically consumers are using up all of their savings. The savings are supporting that consumer spending. And of course, that it's not sustainable, especially if inflation remains stubborn, if prices remain stubborn, but also if interest rates remain elevated for longer. And so that's going to slow down the consumer. And with the slowdown, of course, the Fed will have to recalibrate policy towards the end of the year. So I am optimistic. I think we're still probably going to see at least 1 rate cut in 2024. But yeah, yields have risen about 6 or 7 basis points this morning just on the employment cost news.
Right. So, I try to operate with some of my thinking around the economy from what I see in the real world. Gasoline prices here in suburban Chicago, this past weekend when I filled up, $4.19 a gallon. I saw that in some places in California, it had already gone over $7 a gallon. I look at, the credit card balances that people are carrying, and I go back to the story that CNBC wrote from data from the end of Q4, and the trend line on credit card debt in the United States, and it's scary. It looks like people are waiting for these conditions to simply come to an end. They have really not curbed their spending habits or modified the way that they're spending. And for some people, that's because they can't. I'm looking at this number, and this is from a story that CNBC put out, and a chart that CNBC put out earlier this year. Between 2021 and the end of 2023, total credit card debt in the United States increased from somewhere in the neighborhood of $760 billion to $1.13 trillion. And if you look at this line, it is absolutely it looks out of control. I mean, this is what you would want to see in your brokerage account, or what you would want to see, in terms of your own personal wealth. But this is a debt line, and it's staggering.
Yeah, no, totally. I mean, look, people spend more. People tend to spend more when they expect their income to continue to increase. I should say people also, they tend to save less, right? When they expect their income to continue to increase. The problem is the labor market is cooling. Wage growth has been easing, and inflation has remained somewhat elevated, partly because of the demand factors, but also partly because of the energy prices and everything that's going on abroad. Mm-hmm. So you have those factors at play here. And the fact that interest rates remain higher for longer simply means that at some point, the consumer is going to get squeezed. And I think that's going to happen. Things are slowing. I think people who expected, that hot labor market to continue, I mean, we're seeing it already. I mean, quit rates are down. So I think a lot of people are starting to realize that the good times cannot possibly last forever. And so I'm expecting that consumers to start curbing the spending. And it's going to happen. We just had a very good, strong quarter. And, but unfortunately, the Fed's going to look at that and say, you know what, we made the right decision by delaying those rate cuts. And the stronger the U.S. economy remains, the longer it's going to take before we see those first rate cuts. By the way, it's not just households, right? We also have huge government spending and the increase in budget deficits that is also expansionary, right? So it's not just households; it's also the public sector. You combine all that spending, and of course, you're going to have pressure on prices and interest rates.
Okay, so the big question would be, what do we expect Federal Reserve Chairman Jerome Powell to say, and what do we expect the governors to do with regard to the rates?
Yeah, I expect the rate to remain unchanged in the 5.25% to 5.5% target range. So and I think that's market expectations. I think the Fed is not going to try to tighten the belt even more. Part of the job of tightening the belt is going to come from the market. You're seeing yields at the long end of the curve starting to increase again, at the short end at the start of this week, but also at the long end today after that employment cost report. The 10-year yield is now in the 4.6 range, I think something like 4.65 today. And that's going to continue to increase. I think you're going to continue to see that pressure. And as yields increase, financial conditions are going to tighten, and that's going to do the Fed's job for it. At the same time, the savings that had been accumulated during the pandemic are dwindling, right? I mentioned earlier, you look at the income growth and you compare it to spending growth, and what you see is basically, that is just not sustainable. Spending more than you take it in income is simply not sustainable. And of course, that has continued, right? In the month of March, personal consumption increased by 0.8% or $161 billion compared to just a $100 billion increase in disposable income, right? A 0.5% increase in disposable income. And so what that means to me is that the pile of savings that was accumulated is shrinking. And as those savings continue to shrink in an environment where prices are staying elevated and where interest rates are also staying elevated and where the credit card servicing is going to take a larger share of household budgets, that to me is an environment where the economy is likely to slow later on this year. And if not at the end of this year, we're really going to see it at the start of 2025.
I appreciate your thoughts as always, Dr. O. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.
Are you tired of news that puts politics over people? At the nonprofit Franklin News Foundation, we believe in putting people over politics by delivering nonpartisan news and audio content that serves you, the American taxpayer. With Franklin News Foundation, you can read fact-based, state-focused news for free at thecentersquare.com. You can listen to civil, balanced conversations between policy experts through our podcast network at americastalking.com. Or you can get in-depth news on K-12 education spending, curriculum, and school safety at chalkboardnews.com. It's all free through Franklin, where we put you, the American taxpayer, first in every story, episode, and conversation. And it's only possible through our supporters. Together, we can produce content that puts people over politics and brings Americans the news they deserve. Become a supporter today at franklinnews.org/donate. Once again, that's franklinnews.org/donate.